Hey YouTube, this is Steven with On My Way to Fire, a channel about early retirement and all things investing. Alright, so in today's video, I'm excited to bring this topic to you guys. It's all about mortgage versus investing and the battle of which one's better. So going back a few years ago, let's just give you a quick plot summary if you have been a casual viewer or just seen a few of my videos. I purchased a condo in 2011 and I got a great price on it at the time. And I had a mortgage of around $105,000, which by today's standards is pretty low. But I saved a lot of money to put some money down. And because it's a condo, I couldn't get a 30-year fixed. And because my loan balance was so small, I couldn't find a bank that was willing to take it with a 30-year fixed. So ultimately, I had to do an adjustable rate mortgage. But that terminology is a little confusing for a lot of people. I actually worked in the mortgage business for about 5 years, give or take. And so I was pretty familiar with what I wanted. So I did what was called a 5-1 ARM. And that means that my rate was fixed for 5 years. And then at the 61st month, it was going to change based off LIBOR plus the margin. And you have these 226 or 321 caps and all that stuff. Back in the day, I used to sell these loans on the originations market. But anyway, long story short, I stayed in the loan for 5 years. And ultimately, I did a refinance with a regional bank. And I couldn't find anybody to give me a 30-year fix still. So I had to take another ARM. So I took a 3-1 ARM at that point and actually got an interest rate reduction because I started at about 5 or 5.25% in my original loan. And I think I refinanced it around 78 or 80,000, somewhere around there. So I'd paid it down quite a bit. But I still couldn't find that 30-year fixed. And with condos, they have another thing called a condo hit. So all those things combined, I think I went from 5.25 to like 4.75, I want to say was my rate on the 3-year. So I had 8 years in those loans, and ultimately I refinanced into a home equity line of credit, which is totally different from those. Those prior loans, those ARM loans, were on an amortized schedule, meaning that the payment was fixed for that period, and it included principal and interest. And if I paid extra principal, as in the case of the first 5-year ARM that I had, it didn't adjust the payment lower, it just made more principal proportional in the next payments. So that's really the difference between going from a HELOC to an amortized loan, is that a HELOC is a revolving line of credit that updates and you pay the interest on it based off the balance for that month. And so they usually calculate it on an average daily balance. So just as some more general information, my goal lately has been to try to pay down the HELOC with these little payments of between $30 and $50 pretty much every week. Maybe the one exception I may have is during a week where my payment is due. The payment was around $700. It's currently $691. But as I pay it down, my minimum payment goes down. But of the $691, there's a component that's principal and interest. So it's kind of interesting with this bank that I have. I had another HELOC in the past from another credit union when I had the 5-1 ARM loan. And at that time, theirs was just interest only. And if you wanted to pay more towards it, you could. But this particular bank, because it's a first lien deed of trust with no fixed rate mortgage ahead of it, only the HELOC, they require me to pay principal. So I looked at it a month ago. It was a $692 payment minimum, with $520 of that being interest, meaning $172 went to principal. So between that and my extra payments, I was able to get that payment go down $1, or actually $2. And it's now at $690 with $519 going to interest instead of $520. So probably about $1.50 to $2 difference if you really count it. But because I'm making these little extra payments, that is chipping away at the stone of this loan. But I'm going to get into some details here of my line of thinking and how it's gone for me now that it's been probably close to about 6 years, really since COVID, where I completely switched out of amortized loans and went with the HELOC as my main mortgage. So I'm going to go with the cons first with the HELOC. It is subject to prime rate. So in 2022, we have an interest rate shock where due to Fed policy, money positioning, and just the economy in general, inflation was really, really bad. And I think we actually had a quarter or a month somewhere in there during Biden's term. Again, I'm not a political channel, but I'm just going to give it for reference. I think inflation was actually calculated around 9%. So the effects of the inflation year over year continuing to stay above the 2% Fed target rate they were forced to raise interest rates from the COVID lows where effectively it was zero. I think with the banks, they were doing 0.25. That was the minimum that they would do. So basically, I have a 3-point margin above the Fed's rate. And so that's how most line of credits work. This particular bank that I have gives me 1% below prime rate on everything above 50,000. So my blended rate is 5.8% right now, more or less. As I pay down my principal, my interest rate will actually go up a little bit because I'm benefiting from that 1% negative on the additional. So in this case right now, I'm at a balance of 110,500. So basically 60,500 is at the lower rate. And as I pay it down, it's not really doing me any benefit in terms of a huge amount, but it's chipping away at the loan balance. And I've actually seen my credit score go up quite a bit because I've made a large chunk payment on that loan after selling some stocks in a personal taxable account. All right, so, you know, being in a HELOC instead of a traditional mortgage, first thing that they like to do is they generally want to impound or collect escrow for your taxes and insurance. And so what that means is they want to collect 1/12 of the yearly amount for your property tax and insurance. And I think a lot of us have seen over the last couple years, really the last 2 years especially, insurance rates have really gone up a lot. And I'm in California, so because I bought the home so long ago, over 10 years ago, I'm capped at a 2% increase in my property tax amount year to year. But you know, when I first moved in, it was right around $1,200 per installment, which is twice a year, so about $2,400, maybe a little bit below that. To where now it's close to $2,900, maybe even $3,000 between the payments. So it's gone up a little bit, but it's protected with this Prop 13 here that we have in California. So potentially, if I'm paying $2,900, that'd be an extra $200 and something per month. And then the insurance on top of that used to be around $300. Well, now it's around $750 a year. So, you know, that's doubled and, or more than doubled. And so these amounts would be, you know, combined, let's just say it's $3,600. That'd be $300 a month I would have to pay in addition to the mortgage for the mortgage company to collect on my behalf for these accounts. And it's their responsibility to make the payment on time when they're due. So what ends up happening is, due to all these increases, if you get a payment shock on your insurance bill and you go from, you know, let's say $500 to $800 or whatever your amount is, you know, because we have a lot of wildfire issues here in Southern California, they're going to want to collect that. Now, if you're in a house, you could have an insurance payment of $2,000 to $5,000 a year. Could even be more. So I guess I have to be thankful in some respects that I'm in a condo, that although the percentage is high, relative to the amounts, it's only a few $100s more than what it was before, not thousands of dollars. So with the HELOC, they don't collect taxes and insurance on an impound account. So that's one great thing that I have right now, is I can do that on my own. And for my own benefit, I can pay, because I have State Farm, they allow the insurance to be paid on a credit card. And if you use their company card that used to be issued by State Farm Bank, it's now serviced by US Bank, you get a 3% rebate on your insurance costs. So basically I get around $21 to $25 back. So it's better than nothing. And I did hear, because State Farm is essentially a co-op, I believe, that there's going to be a rebate to homeowner policies sometime this year. I heard this blurb at the end of last year, and I've yet to see the money come back. But during COVID, I did get 2 checks in the mail from them. So hopefully that'll happen. You know, they've been raising rates left and right at every chance, and, you know, petitioning the state commissioner for insurance to raise these rates because of rebuilding costs. And it's just ridiculous. We're just feeling this on all sides, you know, between groceries, gasoline, and cost of living. You know, insurance is probably one of the main high costs for most people that own a home. All right, so now that I'm in this HELOC, I have to make this minimum payment. And they have this funky loan with this 1% below prime rate for everything above 50%. And, you know, my payment's right around $700, a little bit less than that. Now, at one time in 2022, because of all these interest rate increases, my payment, because of the balance being about $140-some thousand, was well over $900. I want to say my highest payment was about $940. And so, again, you know, just a couple $100, but over the course of the year, that's $2,500. And my main goal has been trying to put money into the 401k. And at that point, I was really trying to leverage it, because during COVID, the stocks went down a lot. And I had an opportunity with my job to work in office and work a lot of overtime. And so I took advantage of that for 2 years, and I was able to max out my 401k, more or less. You know, I might have been shy by like $800 the first year, but I definitely did it in 2021. And I wasn't able to do it again until this year. Last year I was about 90% of the max. But anyway, back to the point here. I wanted to buy stocks while they were low, and COVID really showed that that 2 or 3 month period, stocks were down about 30 to 35%, maybe even more depending on what you were looking at. So if I was buying mutual funds that were depressed in that range with pre-tax money, that was my goal, get as much as I can. And I was willing to take the pain on the front end as far as the mortgage payment that I'd have to pay to the bank every month. All right, so since then, we've had a few interest rate decreases. Probably going back about 2 years ago was the first one. I think they did 0.5 point. Then they've done a few quarter point reductions. And then we even had another quarter point reduction a few months ago, which personally, I appreciate it. Thanks for saving me money. Saves me about $20 to $25 a month every time they lower the rate. But the reality, inflation is still very high. And that's the only tool that the Fed has to fight inflation. They do that to support jobs with low interest rates, to get companies hiring and to expand. But the con of that is if they lower rates too quickly or too much, that causes no overheating of the economy and possible speculation, because a lot of people want to borrow cheap money and invest it. Basically play the arbitrage, which is what I'm doing. So that comes down to the main idea of why I took a HELOC, and why I'm accepting a higher interest rate at 5.8% now versus the 5% that I got way back when. And I'm subject to the whims of the federal rate policy, but even if it went up a little bit, I'd be okay with it. Because here's how I look at it. Every paycheck that I have on W-2 income is subject to FICA, which is around 7.5%-ish, 7.8, something like that. That I can't get around. Most of that is going to be related to Social Security, which is just over 6% for the employee's contribution. If you're self-employed, you got to pay both sides, and it's closer to 13%. But I'm an employee for a corporation, so I only pay my side, and then Medicare, disability, all that other garbage you got to pay. Comes out to just over 7%. So, with that in mind, I can't get around that part of it. They're going to take that from my check no matter what. What's great about investment income, whether you earn it in a taxable brokerage account or in a 401k, is you're not subject to that FICA tax. So there's that 6.5-7% savings right there that's not getting taken away. On a tax-deferred 401k through your employer, that money is going pre-tax into the account. And so, those years where I put $19,000 to $20,000 a year into the 401k during those COVID years, those 2021, and part of 22, I couldn't quite max it that year. Maybe I was at like 16,000 or something for that year. That money went in pre-tax and came off the top. And so what ends up happening is between state, which I'm in California, and Fed, the more money you earn, the more taxes you pay in those next brackets. So once you start clearing into the mid 50,000s after deductions, you're really going to get hit with a lot of taxes for everything that you earn. So effectively, what I'm trying to do is get out of that 30% combined bracket between Fed and state. And so here's the math that it comes down to. On last year's tax return, I saved somewhere around $6,350 in income tax between federal and state. Now, part of that is, the main part really is going to be the 401k, because that comes off the top of the AGI, adjusted gross income. Well, then on top of that, I did the health savings account because I have a high deductible health plan. And my employer actually has a match on that program as well. So they give me like around $30 or $32 a check to be in that. So that's pretty cool. So that's just basically free money for participating in it. So the bummer part of it, though, is the state of California is one of very few states, I want to say it's about 4 or 5, that does not recognize the health savings account as a deduction, whereas on federal taxes they do. So on federal income tax, you have a much higher much higher standard deduction versus state. So I usually always end up owing state money, and I ended up having to adjust my tax withholding this year to give the state more income from my paycheck versus just the standard one deduction that I have for myself, or withholding, I should say. All right, so let's get into the math here. So now that my payment's below $700 and I've endured some of this pain during the COVID years and I invested, what's done in the past is done. Basically what's happening is I'm paying about $8,500 a year to maintain the mortgage payment. And that's just basically a necessary evil, is the way I see it. It's a nag. It's just something that's there. But what's nice is I do see that little $1 or $2 go in the direction to more principal every month and less interest as I pay that loan down. But what that loan does for me is huge. It's huge, guys. And a lot of people would probably be scared to do this because it's a bit of a risk. But everything in life is a risk. Getting in your car and going on the freeway is a risk. Getting in an airplane and taking a flight is a risk. It's a very tiny risk, but there's still a risk there. You could have an argument with me that investing can be like gambling. Yes, I agree. If you're putting large sums of money to work at one time and betting on a trade, essentially that is gambling. But investing is different. Investing is, the way I see it, something that you do over the long term and build into your budget as a savings discipline. It's not a one-time bet. It's a series of habits that you build upon month after month, year after year, and decade after decade that can really grow your wealth. And so, I didn't realize at the time. I was just thinking, hey, I want to save money on my taxes and I want my money to grow. But essentially that's a term called wealth building. And, people use this to sell fancy courses and sell books. I'm not here to sell you anything. I'm just here to give you general information and give a real life experience to somebody who's done this. And, if you don't like what I'm saying, maybe it doesn't apply to you, but maybe there's a few little tidbits here that might be able to help you in your situation. So with this $8,500, what does it buy me? It buys me options. And what I mean by options, it means freedom to do what I want. And let's think about it. If I max my 401k contribution at $24,500 this year, that comes right off my AGI, and I'm saving taxes at about 30 to probably 20 something percent, 24% maybe on the next bracket below. So that's a significant amount of savings for that chunk of money. And what it does is it grows tax deferred in the 401k with these index funds and these actively managed funds that I have through my workplace, and they're gonna grow. And you might have a bad year here and there, you might have a bad quarter, but I don't let it get to me. You gotta do something what's called seeing the forest through the trees. And that's where you don't let the details of the immediate situation get in the way of the bigger goal. And so think about it. If I've been able to put between $20,000 and $15,000 in the 401k consistently year after year for several years, you start accumulating over $100,000. You start having some growth in those accounts, and any small percentage of growth starts to be huge. So here's the potential: $24,500 in the 401k because I'm under 50 years old. $7,500 in the Roth IRA is the max. And I didn't double check it, but I think the health savings account on a single person, I think I can put somewhere around $4,000 to $5,000 a year in it. So add it all up, that's well over $30,000, maybe $35,000, somewhere in there, potentially, that I could put into the stock market at the cost of $8,500. And, I've seen people quote figures of the stock market and be very general. And to somebody who doesn't trade all the time and doesn't see the market day to day and just kind of hears about it, just through the news, you might not think it's possible. But the quote that I hear the most is somewhere between 7 and 10% a year is what you can expect on a return. The part that they're not telling you is there's going to be periods where the stock market's down 10 or 20%, but you're continuing to buy during your paycheck contributions. And that's what happens when the market ends up recovering. All those low purchases are brought up, and then now you're back to buying at the current rate, and your account grows. And so blended, you effectively get like a 7 to 10% return. I've had years in the 401k, the workplace plan, not my individual trading account, that it was up 17 to 18%. I've had some years where it was down probably about 7 to 8%. Generally, you'll still have a quarter that performs well that will balance it out, but that's just how it rolls. And so I see it as an opportunity that those purchases are buying me more shares at a better price during those periods, and ultimately we lead to rallies. And we're really in an interesting inflection point really in the world right now with so much technology available that I think people are kind of freaked out because AI is starting to take over. There's a lot of potential for regular white collar jobs to be lost, and people are panicking that, maybe things can't continue the way they are. And if you look at the headlines of the major tech companies like Meta, Apple, Google, Amazon, consistently they talk about layoffs. They often cite AI and efficiencies, and they can cut the cost of human capital and replace it with computer programs. But at what cost? It's going to require a lot of data center investment. That's what's called CapEx spending. And they're probably going to have to come to some equilibrium to figure out that they still need people to oversee, because I even use ChatGPT in my personal life, just on stupid topics, pop culture stuff that I'm interested in, and it continuously gets stuff wrong, and I have to correct it. But over time, these things are going to get better and more efficient. And for some of these companies like Ford, they let go of a bunch of people, and they end up having to hire over 300 engineers back because they couldn't get the AI to work the way they thought it would. Ultimately, what's going to happen? They're probably going to shadow those employees with AI modeling and teach that AI how to do the job of these people and reduce those 300 and some people that came back and keep the minimum. Because what's the reality, guys? The CEOs need their bonuses, and the way they're going to do that is by reducing headcount, cutting costs, and increasing shareholder price, shareholder value, and in turn increasing the share price. So that's ultimately what it comes down to. So who knows how long I'm even potentially employable with the finance job that I have. I could be replaced by AI. So, these are things you have to think about. But, 10, 12 years ago when I started this, being aggressive about it, I didn't have that in mind. So let's just do the math. Potential, $85,000 in mortgage payments. Let's just keep it at what I have currently for over 10 years is the cost and after-tax money. But the potential to have between $300,000 and $350,000 into the stock market invested pre-tax with potential of growth between 7 and 10% every year probably gets you closer to $500,000 by the time that those 10 years are done. So it's pretty amazing what can happen if you learn how to leverage risk and interest and debt in your own favor. And really, with the purpose of my channel, I want to document the journey of trying to get to an early retirement in my early 50s, probably around 52, 53. That's really my goal. And I want to be able to look back on this video a few years from now and say, wow, it's pretty cool to see that I've done this progression and I made it happen. But, looking back 10 years ago when I started it, it was really just about investing in myself and putting some money into the market for my retirement because I didn't really have anything long-term set. I had gotten a stock trading account going again after being dormant with trading for a little bit over 10 years during summer of 2024. So I think it was the middle of July. So this is like my 12-month anniversary of really getting serious with learning the stock market, learning the tax code, believing in myself, and committing to a goal. So, in the end, I'm happy that I made this decision. It was not an easy ride. There's been a lot of bumps along the way, especially during that 2022 period when interest rates were rising, stock prices were going down. The divergence of this plan was a little bit in question of what I was doing, but I had to see it out long term to say, hey, what's going to happen when all of this kind of, blows over and we get into a regular stock market again? So what I did was I used to look at the history of past bear markets from the financial crisis and then also through COVID are the two big ones that I lived through for some guidance and, just some reassurance on how long it would last. And, I thought, I am working, so I'm able to contribute to my 401k. So that should be a good deal for right now to get these mutual funds while they're low. So that's my story, guys. Potential $85,000 in mortgage payments for over $300,000 in stock investments, potentially. There's going to be years where I can't quite get to the max. Maybe I only get to 60 to 80% of those numbers. But, in the long run, it's going to be well worth it. And I think a lot of people just don't want to take the time to see that there's alternate ways to do things. And essentially what I'm doing is I'm robbing Peter to pay Paul, right? I'm keeping this debt ongoing at this 5.8% for the ability to put money into the market. And a lot of people might not see that risk as being worth their time, but I see the spread of over 25%, between 23 and 25%, I should say, of tax that I would owe, in addition to to having these mutual funds grow. So that's how I look at it. And if you multiply it by several years, the savings is incredible, the growth is incredible, and I just feel that it's the best decision that I ever made was to really get serious about it after owning a home. And to put some perspective on it, guys, I was at a point where I had the loan paid down to about $20,000 when I did a cash out refinance on the HELOC the first time. So, I could have paid it off, but I wouldn't have as much invested as I do now. So that's the trade-off, guys. It's really just, do you want to have this nagging payment and, take the risk of putting your money into the market and seeing what it can do and be willing to actively manage it? It's not like I just put it into these mutual funds and never touch it again. I have to be pretty nimble and react to what's happening in the stock market. So appreciate you guys watching. It's a little bit longer video, but it's something I've been wanting to do for a while. And thanks so much. If you got anything out of it, please give me a like and subscribe. And if you enjoyed this topic, please look through my other videos. This is my video number 40. So thanks again, and we'll see you in the next video.